All right, good morning. Hopefully you all can hear me. And this is Robert Hunter speaking. Many of you know I lead the Hunter Haverchak Altman Hotel Group of M&M, based in Fort Lauderdale, Greenville, South Carolina, and Philadelphia. We appreciate you dialing in. At times right now, I think it feels like things are advancing at a snail's pace, and other times it feels like it's a whirlwind. So either way, a lot has evolved since our first webinar 19 days ago, so we felt like a second one was warranted. As I mentioned before, I know there are a ton of webinars being thrown at you right now, so we appreciate you all taking the time to listen to ours. And the general goal of our team's activity through COVID has been topical substance rather than flash and fluff. And over the last few weeks, as we followed up after the first presentation and also just gone about our normal routine business, we've been carefully taking note of what pressing questions or area concerns are, and particularly related to debt. And as I mentioned before, our team covers a lot of ground, have business focused on 17 states and a deal wheelhouse ranging from about 2 million to 40 million. So despite a very diverse clientele, we've witnessed and noticed pretty much a universal uncertainty related to debt since March, and really on several levels. As a result, that's once again the focal point of our presentation. Both my guests are in the trenches every day in their respective fields, and both are actually making progress at an undeniably tough time, which I'll let them expand on. But hopefully we can hit on major areas of interest over the next 30, 40 minutes, and hopefully you all get something out of it. With that, I will introduce my first guest, Tanya Hart-Little. Tanya's the founder and CEO of Hart Advisors Group and Hart Capital Partners. Her team's completed in excess of $5 billion in commercial loan transactions since inception. And earlier in her career, Tanya co-launched the Royal Bank of Canada's CMBS capital markets platform, and as COO of that platform. She was instrumental in deploying over $2.3 billion in loans in just the first year. And she also spent time as managing director for GE Real Estate's North American Lending Division. So long track record, and without a doubt an expert in the field. And she has an extensive list of personal and professional accomplishments and recognitions, and we're happy to have her on to discuss one particular area of expertise, which is modifying securitized debt and CMBS market in general. So Tanya, we appreciate your time and insight. Take it away.
Thank you so much, Robert, and thank you so much for your time and for including me today. So Robert was kind enough. You can hear me okay, Robert? Just to make sure.
Loud and clear.
Okay, yep. Perfect. Okay, so he was kind enough. I had asked him to provide me with some of his questions that he hears most often from borrowers and hotel owners. And so I'm going to, kind of quickly go from topic to topic. And if you'll just advance the slide one, then you'll see the topics we're going to be talking about today and one of my better pictures. Anyway, I want to talk about some things. I spent some time right before this call, not only reviewing what he asked me to speak about, but speaking yesterday to various special servicers to try to give you kind of that round two, kind of what's next. And with that said, I want to just talk about a few topics you might have heard, might not have heard, but I'm going to start out by just talking about pooling and servicing agreements. So for those of you that don't know what a pooling and servicing agreement is, it's really important to your CMBS loan. It's basically the agreement that's created when the loans are pooled together, and that can be from multiple originators, and they're packaged to create these mortgage-backed securities, or CMBS. That security is then sold to investors. And this agreement basically governs the roles of the different parties, the master servicer, the special servicer, the trustee, multiple parties, and then also the rights of the investors. And as I answer your questions, I'm going to refer to this a lot because, CMBS is complicated in ways that you weren't aware of at the time that you originated your loan, nor did you even know you were really a party in a way to these pooling and servicing agreements. You're not directly, but you are indirectly on what they can do for you. And I think one of the things we here and my associates here at Heart Advisors do best is really setting expectations and understanding each person's loan and what can or can't really be done. It's not a broad brush. So with that, I'm going to ask a couple of things. One of the things that Robert asked me is common resolutions that are granted and whether or not it's being done with the master or the special or both. We have had some early wins, and I'll show you those at the end of the presentation that have been done. And most of the covenants or consents right now that are being processed, they're getting processed by the special servicer as what we call a referred matter. So you might go through a Midland or a Wells or something to kind of make your request. But then it's really kind of going over to some people over on your special servicing side, and some of you might see that as what we call a referred matter. And that's good for a borrower in that referred matter is not considered what is a specially serviced loan, which is different. And we'll talk about that. But that allows them to really not start the clock on a bunch of fees and concerns that you have about quote unquote being in special servicing. Master servicers are generally handling general matters like late fee waivers, rebalancing of reserves, initial payment defaults. And that's because these pooling and servicing agreements only allow them to handle certain things. They really are hand tied on if you want a deeper type of modification. Some of the noticeable differences between, each of the servicers, they do have a little bit of their own niches and nuances that are happening. If you're receiving sometimes a positive or a negative response, it might not necessarily be in the negative case that, hey, we don't really want to do your deal or we don't want to give you relief. It might be because they can't. And unfortunately, a lot of people, because of the volume, these asset managers may just say, sorry, we can't do that. And what you need to understand and what some groups that work with CMBS loans can help you understand is really why they can't do certain things. And that's a lot better than just hearing, no, I can't help you in your time of need. Most servicers have been accommodating some of these requests within reason. If they are reasonable requests, if they're well thought out and presented, we have received yeses from the major players, Rialto, L&R, Midland. And it's not just on one type of request, and I'll show you that in the end on some of the things that we asked for were multiple. Rialto's been a little picky on items, and by that I mean they're wanting some recourse on reserves, and there's been some cash management provisions. At the end of the day, it's a balancing act, because I do believe some of those things they can and will let go of with the right type of balance on what you're asking for in that negotiation. It's not just, hey, I need relief. It's really a structure. And, with that, I would also say persistence pays off. We have associates here that are calling daily on reserve requests or tax and insurance rebalances or waiving late fees. And a lot of things are getting lost. There are people that need their capital reserve reimbursements back to them, and they're not seeing them for months. And those are important to you, especially when you're not even sure how the next mortgage payment is going to be made. So it's important that, there's a way to handle those and there's a way to get their attention, but sometimes a streamlined approach or going through special to get to the master can work for some of us that know people on those sides and can get something done a little bit faster. I was asked about the likelihood of government intervention. I've talked to some lobbyists that I think are taking careful and considerate approaches. One of them that I've talked to several times has met with the president and his counsel about CMBS relief specifically for borrowers. And, I think that there are big groups, big hotel groups that are behind that and that are working on those. And I do think that they're going to continue their efforts, and we're continuing to follow their efforts. But CMBS being not a government type of debt vehicle and the complexities of it, I'm not going to give a lot of hope to there being an intervention. And I'm just being honest with what my thought is. Um, how are decisions made with the CCRs? Let me talk about that for a minute. CCR is what we call controlling class representative. So you might have hundreds or thousands of bondholders or investors that are in these pools. And so there's usually one representative, they call it a CCR, or controlling class representative. And they are really the decision makers because they usually hold some kind of stake in the losses of the bonds. So it's complex in that you might be talking to an asset manager at a special servicer, and then they report up to a committee. And that committee can make certain recommendations, but ultimately there might then be the CCR above that has kind of the final word on whether relief is given and how much relief. And this comes to play a lot when we get into special servicing. So I think what I want everyone to understand is there's multiple tranches of people and decision makers, and that asset manager has a box that he can offer to you. And if anything else can be offered, a lot of times that just takes negotiation skill and just understanding which options are truly options. So that's kind of a quick down and dirty on that. Do they address individual loans when giving special direction? Yeah, absolutely. I mean, each of these are limited liability entities, and they are looked at very specifically on a case-by-case basis. So these special purpose entities are individual. Not one loan is the same, and that doesn't mean if you know a hotel owner that got one response that you're going to get the same response, or you may get a better response. And again, a lot of times that goes back to the pooling and servicing agreements. We want to talk a little bit about triggers for recourse. One thing that I've realized with hotel owners specifically, as we've worked with them really a lot over the past 3 to 5 years, is that much of your debt is with banks and is recourse. So I have a client right now that has 20 hotel loans that is recourse and 3 that are CMBS, and he has a hard time balancing the difference between those, what kind of relief he can get, and why recourse he should really care about it when it comes to CMBS. And I think at the end of the day, you have to look at that the defaults associated with recourse on a CMBS loan can trigger things immediate. So it's not just saying, hey, I have a recourse loan and I know it's recourse. If these certain things happen, why should I care? It's really that those triggers can cause an immediate action that is detrimental to you and your property. So understanding, a lot of people trip recourse triggers and don't even really realize they've done it. So that's important to understand if you're looking for some sort of help on CMBS loans. Let's see. Let's talk a little bit about the government stimulus and kind of what we've had. Basically, right now, there have been almost everyone has a trigger for debt coverage ratio. There's just no way not to. I think a lot of people are asking about, hey, is it going to be enforced? Listen, the lenders and the CMBS lenders want to keep that option, obviously, but there's probably not a person out there that really hasn't triggered it at this point. We're not seeing, a harsh enforcement like we would have seen before. And in fact, even when I have triggers, I have a couple of hotels where we've actually triggered kind of a cash management situation, and then we turned around and got it waived. So there's serious covenants for you that are out there, and I understand it. But again, managing that balance and managing kind of how you've managed your hotel, how you're managing this time is really important to get those waivers ultimately. So I think that's important. The PPPs are kind of a given mainly because they are a forgivable and not a collateralized, if you will, by the property. The reason you're receiving so many no's on the EIDLs is exactly that. It's an additional lien on the asset. I think that's pretty much across the board that we've seen that those aren't being approved. So that's really why. Let's talk a little bit about next round 2 modifications. You know, I kind of put this into the first 90 days has happened. We're really going into what we call secondary modifications, or phase 2, if you ask me. And we are starting to see, and the servicers are very well aware that, you know, not everything is going to be, you know, rosy as we move forward. And they're expecting that. So a lot of these, I know how what we've done with some of our clients is we might have gone for a short-term modification, but we're kind of waiting to kind of see what the performance has been for a couple of months to see just how deep we need to make those requests. We have made some of those requests, and we are getting some positive feedback on kind of what they will consider going forward. But quite frankly, I spoke to Midland, L&R, and Rialto yesterday, and none of the asset managers that I'd spoke to have actually seen, you know, it go so far as to getting approvals on kind of deeper modifications yet. And it's just because they're still processing and papering forbearance requests, if you will. So it's to come. It's to start now. It will start now and go into the fall. And I don't really think everyone has been scared to go into special servicing, and rightfully so. There's some concerns about going into special servicing and costs associated with that are true concerns of any hospitality owner, any retail owner. We have the same thing. But I also think that there's going to, because the pooling servicing agreements for the second round of CMBS versus the pre-2008-9 CMBS is different. I do think there'll be more workouts. I do think that there will be waivers of a lot of this default interest and late fees, although some of it, you know, won't happen. But in order to get, you know, some of the deeper modifications, it just cannot be handled any other way, period, the end. So we're trying right now to push everything through as a transferred matter, not only for just 3-month relief, but multiple other types of relief as well, to try to save our clients money. But ultimately, there will have to be a conversation, depending on the asset and depending on the need, to move to special servicing if that's appropriate. So I think I've answered that. And I'm just going to touch on, you know, hiring a consultant, an attorney, pros and cons, and then I think I'll wrap up with this because I want the other guests to have plenty of time to visit. You know, what I tell my clients a lot is CMBS is great until you have an issue. And it's great debt, it's non-recourse, it's long-term, but you still have equity in your assets to protect. And most hospitality groups and owners, you know, this is very personal. There are a lot of, when you look at hiring a consultant or attorney, there are a lot of people in this space that in the last 60, 90 days have jumped into this space as a placeholder for them, as an income maker. They may or may not have the appropriate experience to actually understand what can and can't be done. So that's just something you should look at. How you work with servicers is important. We would rather collaborate for win-win solutions than litigation. I believe litigation, unfortunately, always costs the borrower more. And if you're hiring an attorney, they're very well qualified, don't get me wrong, but the attorney on the special servicer side has to be involved. So that means you're paying your attorney to talk to their attorney. So you're paying two attorneys, and then that message has to go down to the asset manager. So a lot of times people choose consultants over attorneys to handle the business points and then ultimately turn it back to their attorneys to handle the paperwork and documentation. PSAs are important. We are looking at them on every individual deal to understand what can be done for our clients. There's really no need to tell someone or sell something that says, hey, I can get this done if the PSA won't allow it. So I think, that's an important thing when picking someone to look at what's going on. And relationships with the servicers, we've had them for the past 10 years. I'm going to tell you, a lot of people have left the servicing world. There's a lot of new people that have come in, but I think how someone's handled themselves over the last 10 years with the servicers and their requests and how they're working with the servicers goes a long way. And then communication and setting expectations. I think overall we're number one in this area. We probably give out more advice, free advice before we will engage someone, but we want people to understand this process, understand it's not easy, but understand that working with, I know my team is going to be better than going it alone. So I hope that is quick and it answered a lot of questions. I think I'm 2 minutes over, Robert, but
That's fine. It's perfect. And one thing I might add to what you're just saying related to a consultant, before we were going to feature any consultant in our webinar, we put in a few calls to contacted servicers just to try to understand the relationship and the dynamic, really just to make sure they didn't perceive it as being adversarial when a consultant comes in. And our feedback, whatever it's worth from the servicers, was that the consultant really helps streamline things and makes the process more efficient for the servicer, and to the point that they view it as a positive, just take the conversation to the next level immediately. So
yeah, and it helps, especially just set the expectations for clients overall. But if you want to flip quickly to the next slide here, and we can come back to this in the end. These are 3 COVID reliefs that we've done, and you can see that multiple items had to be done for each property. And so the first 2 are COVID. The second one was actually a little bit deeper in special servicing. But you can see there, we believe that, at the end of the day, waivers of default interest will happen. Sometimes they're big waivers of default interest. And I think, it's good for everyone. Not to say that there wasn't a lot of give on that deal, but I really don't want people to be totally scared of special servicing, because I do think more will get worked out in this cycle than not. So with that said, I'm going to turn it over and look forward to it.
Great information. And the contact information for your marketing team was up, and on our last slide, we'll have full contact information, just so if somebody wants to reach out,
Sure.
they can contact you. And if somebody were to contact you, I think there's just a lot of just questions about how the process works, but do you all just get some information basically in some sort of consultation at first to try to figure out?
Absolutely. Sometimes we have multiple consultations, but
Okay.
that's fine. We want you to be prepared before you engage us. We want you to understand what you're getting into and understand what we can do for you.
Okay. Thank you very much for the time and the insights. Great information and evolving every day. So Thank you. And we will move on. Just again, talking about the context of this presentation, and it's important to note that basically every day, I personally, I'm sure it's the same for everybody in my business, speak with an owner who tells us their frustration level with securitized loans is high enough that they'll likely pursue another way to fund hotels in the future. And I realize some of that may be short-term fatigue, but it still seems like a good time to introduce an outlet for for owners to evaluate future options. So as a result, I asked Tim Marr, the principal of Pinnacle Hotel Finance, to join today also. There are many reasons I wanted Tim to participate, but primarily it's many years of focusing solely on financing hotels and his reputation in the market and unique real-time understanding of where the market for hotel lending is right now. He's successfully navigated multiple cycles and has found a way to continue doing business during the current climate, which is rare in a way. I mean, he's financed over 150 hotels, total volume of over $1 billion, and may importantly right now, that volume has come from a diverse array of sources. So Tim, it's great to have you on, and I'll turn it over to you. Thank you.
Yeah, thanks for the nice introduction, Rob. Well, hey, good morning, everybody. Appreciate everybody joining this call. As Robert had alluded to, my company's Pinnacle Hotel Finance. Effectively, we're a loan brokerage company that is really solely focused in on debt financing for hotels. So really, hotels are the only sandbox that I've played in for really probably the last 12 or 13 years. So my experience in the industry really kind of goes back to 2007, 2008. Right before the market had rolled over in 2008, 2009. So really my early experience in this industry financing hotels was during the last recession. A lot of the financing that I was doing was through different government guaranteed programs with the SBA, with some USDA-backed financing, and then really just trying to find one-off banks during those years that were still lending on hotels. I think it was a good experience for me just starting at that time because there was not a whole lot of capital that was flowing into hotels. So as the market really evolved, say, over the last 10 years, obviously the options for owners and financing in general has developed quite a bit. If I could maybe just, I'll touch on a little bit about what my company really does and kind of the areas that we're focused. So a lot of what we do is limited service hotels, kind of budget economy, mid-scale properties, extended stay, loan amounts anywhere from like $2 to $20 million. Doesn't say we can't do loans higher, but really that's just where a lot of the properties that we do fall in, and a lot of it's multi-unit owners. So as far as the space that we're in with debt, really non-recourse and non-recourse financing. On the recourse side, traditionally local banks, regional banks, national banks, credit unions, other types of balance sheet lenders. And then again, the government guaranteed programs, SBA, 7A, 504, USDA, BNI. And then on the non-recourse side, CMBS on the permanent debt side, and then on the floating rate non-recourse loans that have been active for a number of years through debt funds or non-bank balance sheet lenders, lenders that participate in the CLO market or mortgage REITs. So try to cover a vast variety of different options for owners. I would say really the only field that I have not been in historically with debt is through life insurance companies, through EB-5, and not really involved in PACE financing either. So if I could just transition now and just maybe provide a little bit of context as far as where the market has been over the last 10 years, and then I'll kind of segue into where we are now and over the last 90 days. So as I had mentioned, kind of going back into 2009, 10, 11, financing was scarce, not a whole lot was being done. But as the industry started to perform better, hotel performance was on an upward trajectory. As you got into, say, 2011, 2012, on the non-recourse side, CMBS started to thaw, which effectively meant, hotels were getting done and financed via CMBS. Some of the non-bank balance sheet lenders were starting to dip their toes back in as well. So you started to see more activity with non-recourse lenders. And then on the recourse side, again, I think banks started to get a little bit more comfortable once they were able to prune through some of the bad hotel loans that they had to get off their balance sheets, and just started to see that the industry itself was kind of coming back. And so I think as you kind of rolled through 2011, 12, and 13, and 14, as the market was improving, you started to see this resurgence of lenders coming into the space. And then I guess once you really hit about 2015, the market had obviously been performing well for the most part for a number of years. Lenders were comfortable lending on hotels. I would say it was really a borrower's market, and it has been a borrower's market here for probably the last 5 years or so, all bet for construction financing. And so effectively, whether it be, again, non-recourse debt, recourse debt, there's just been a number of different options out there for owners to finance, specifically acquisitions, refinances, whether or not they contain PIPs, here for the last number of years. So I think that, most folks who have existing assets and were out in the finance markets would agree that it's, those properties were probably well received and well received by the lenders that were in the space or looking at their deals for the last number of years. So just kind of transitioning now into, where are we at today and kind of what do I mean by today? I mean, really over the last 90 days. Obviously, once we got into mid-March, everything has changed dramatically. I would say it was within a period of about a week or two in mid-March, once COVID hit, the lending environment and just the tone of the market changed dramatically. I can tell you that transactions we were working on, term sheets issued, commitments issued, were either pulled, they were put on pause, sidelined, whatever you want to call it, but effectively, I think everybody just stopped and said, let's reassess and figure out, where this is going to go. So the past 90 days, to say the least, it's been pretty grim. Not a whole lot of financing getting done. I think one of the maybe silver linings is you are starting to see hotels in general, I think, starting to perform a little bit better as they get through May and now into June. So, perhaps that starts to open up here to some degree. But just a totally different tone in the market here over the last 90 days. And, talking about some types of lenders and what their responses have been. With respect to non-recourse financing, I'll touch on CMBS first. So effectively, there's no CMBS securitizations happening that contain hotels right now. There is securitizations going off over the past month or so. It's just hotels are not part of those pools. So you have multifamily, some office, some self-storage, industrial, some credit tenant retail. But for the most part, hotels are left out of that basket for now. So really nothing is happening with new originations on the CMBS side. As far as other sort of non-bank, either balance sheet lenders or, REITs or debt funds, the ones that I've spoken to over the last few months have basically said they're on the sideline, or perhaps if they're looking at deals, they just have to be, kind of low-hanging fruit or gimme deals where it's low leveraged. There's some compelling reason for them to do the deal. But for the most part, I would say most of those lenders are kind of in a wait-and-see pattern as well. On the recourse side, again, what I mean is, local banks, credit unions, national banks, balance sheet lenders who portfolio and service their own loans. I've reached out to several of these types of lenders on different projects over the last few months. It's really quick no's. I would say that I've had some commercial lenders that I speak with who, have given me responses that, basically would say, I'm concerned about even kind of walking down the hall to speak with my chief lending or chief credit officer right now about this type of request, or our credit committees just, they're not going to be receptive to it at all. And I think a lot of that's primarily due to a lot of the focus for lenders right now is just determining what does their hotel loan portfolio look like going through, say, the next 6 months as they're forbearing, modifying, having to work out, trying to figure out what the health of their guarantors or sponsors are going to look like, and how solvent they're going to be coming out of this downturn. So I think that most lenders, I'll bet, maybe with the exception if you have a long-standing relationship with a bank, and effectively you're presenting them a loan that, again, is very low leveraged, where the property is coming back maybe faster than others. Maybe you can find some one-off deals here or there, but for the most part, I would say that banks are kind of in a holding pattern and just not really open to new opportunities right now. As far as some of the government guaranteed loans, and what I mean by this is really SBA 7A, SBA 504, and the USDA B&I program. That's the space right now that deals are happening. It looks like a shell of what it was just, say, 6 to 12 months ago, meaning that there was hundreds of lenders that were in that space and historically have been. That has shrunk down quite a bit, but there are still lenders in that space that are making loans. Obviously, not all hotel loans fit within those boxes, but that is really kind of where my focus is today. It's really where I see the opportunities to actually get deals closed, and so that's where really a lot of my focus is today. As far as transitioning into kind of when does lending return, or at least my opinion on when things start to come back, I think that this is really going to vary by sector. Touching specifically first on non-recourse debt, and I'll talk about CMBS first, permanent financing. I think that the fundamental challenge you have with CMBS right now is the typical hotel is suffering such a dramatic decrease in RevPAR really from March, April, May, and I would think that that's probably on any given hotel going to continue here for the next several months, where the fundamental data point or piece of data that CMBS typically uses to back into a loan sizing or to underwrite has been typically a rolling 12-month P&L. And the problem is a rolling 12-month P&Ls are going to look poor for almost every hotel in the United States for at least, say, the next year and a half or so. And so even if CMBS does start to come back and thaw, you're going to have a problem where a lot of loans simply are not going to qualify. They're going to have debt on the property currently that is too high, and they're not going to be able to get a new loan to pay off that debt. So unless they're plugging that gap with equity, I think you're going to have an issue where CMBS starts to come back. Lenders are open, but there's just not going to be a whole lot of loans that qualify until we start to see, ADR and occupancy levels come back to where they were in 2017, 18, and 19, which, others have kind of voiced their opinion on when that may be. As far as some of the floating rate non-recourse financing options, and again, what I mean by that is mortgage REITs, non-bank lenders, debt funds. There's a variety of these lenders that have been active over the last number of years. I think that those groups eventually that are healthy and have healthy balance sheets will start to dip their toes back into the market. I think they'll sense that there's an opportunity at some point, specifically on acquisition deals, groups that have, a vast amount of capital that are coming in, perhaps acquiring an asset that is significantly less than what it would have been acquired for, say, a year or so ago. I think that's where some of these type of lenders will come in and really see that there's an opportunity to make loans that are on a per key basis much lower than what they would have made, just 6-12 months ago. And the fact that banks in general will probably be a lot more conservative and just not there to a great extent, I think some of these lenders probably serve to prosper if they're active in that space. And I think historically, if you look back, lenders that typically enter the space when a market's starting to recover usually book really good loans. Assuming the market continues on an upward trajectory, I would say lenders that did loans in 2011, 12, and 13 made really good loans as they rode the market up, perhaps more so than loans that were made in 17, 18, and 19. So I do see some of these non-recourse floating rate loans coming back. As many of you probably know, these loans primarily are sort of forward-looking underwriting or pro forma based, so they do not have to rely solely on kind of a look-back underwrite like CMBS does. A lot of these are, sort of turnaround plays, or there's some business plan or story in the deal or value-add component where, a group is buying a hotel. They're going to rebrand, they're going to PIP it, they're going to replace the management with a group that's more capable, or some story behind why what the numbers are today are less than what they can be in a year, 2 or 3 down the road when that lender looks to get taken out. So expect that area in itself, again, to come back here a little bit early now, but as we get perhaps later into this year and into next year, I do expect groups to re-enter that space. As far as recourse financing, again, banks and credit unions, I think it's yet to be determined. I would say, again, it's pretty grim right now. I don't think a whole lot of lenders are going to be looking to make these type of loans right now. I think, though, as you do get perhaps later into this year, into next year, if lenders are able to see, kind of this upward or inclining RevPAR stats on hotels that, is perhaps some sorts of return to normal, I think that lenders will start to, get back in the space very slowly, though. I think it's going to be very conservative underwriting with, high equity requirements or low leverage. I think they're going to be very particular with who they lend to. I think, guarantors or sponsors that have a lot of cash is going to be something that's really focused on, that effectively just kind of can weather a downturn or kind of pull themselves through this, this turbulence that everybody's in right now. So again, would expect those to come back, but very slowly. And I think that lenders overall are going to spend more time, say over the next 6 or 12 months, figuring out, how to protect and preserve loans on their portfolio right now than have an emphasis on making new loans. If I could maybe just now transition into kind of what deals are getting done today. I alluded to this a little earlier ago. Before I cover these programs, I think one of the things to point out is effectively right now, if you financed your hotel, say anytime over the last 3 or 4 years, and you have an attractive interest rate and it was leveraged up to a certain level, I think what a lot of owners should realize is the best loan that is out there for your hotel is probably the loan that's already there. Because again, the idea of taking that loan and refinancing it out right now with just the lack of options that exist in the market, you're going to get a very cold reception from the financing market. So I think a lot of folks are better served to try to work these loans out, perhaps, calling Tanya's company on the CMBS side, or just trying to work with their lenders as best they can to try to get these loans worked out, modified, whatever it may be, because effectively if a borrower gets put on the chopping block and has to replace that loan, I would tell you that most cases today, that's going to require fresh equity to come in unless the property has been able to kind of weather this downturn and has not been significantly impacted by COVID here for the last 90 days. So just really encourage folks to, unless you have to borrow money right now or unless it's an acquisition, to try to work with your existing lenders to try to work these out for the time being. As far as programs itself, so again, conventional banks, I think that they're going to be few and far between, recourse loans, low leverage, strong cash flow requirements. They're going to look for guarantors that have outside income, those that have high levels of liquidity, but I still expect that to be something that is somewhat of a shell of what it was for the last few years, at least for the next 6 to 12 months going forward. Deals that are getting done, and again, this is really where my focus is here now and over the last, say, 30, 45 days. So the SBA 7A program, deals are happening there. Basically, the fundamental reason behind why the 7A program is still functioning well as the USDA B&I program is there's an active secondary market that buys government guaranteed debt. That market is still liquid. And so effectively banks who make these loans, they get a partial guarantee from these federal agencies, whether it be SBA or USDA, and they can effectively sell off a large portion of these loans. They can make a premium, recycle that capital, continue to make new loans. And that secondary market, unlike CMBS, doesn't decide whether or not it's going to take hotels. Effectively, lenders can close hotel loans and sell that. The fact that it has the guarantee from the government, the secondary market buys it regardless of what the asset class is itself. So as far as terms on 7A loans, typically $5 million on the 7A side. Some lenders we do these with will blend in an additional $2 million or so. So sometimes you can take these up around $7 million. So clearly these loans don't work if you need $12 or $15 million. The rates on these loans typically floating over prime, anywhere from upper 4s to low 5s today. The terms on these loans, 25 years, they're fully amortizing, so there's no balloon. There's prepayment penalties for the first 3 years that burn off after year 3. So, they're relatively flexible loans in that respect. One of the highlights of these loans is the leverage component. So typically these go up to 80% leverage. So they're great for acquisitions. If you're buying something, we'll take the price, the PIP, the franchise fee, blend in some working capital, the SBA fee, closing costs. So kind of your fully baked capital stack. and we can typically do loans at 80% of that. So great way to leverage. As far as the guarantors, so anybody that owns 20% or more of the borrowing entity is required to provide a full guarantee on the loan. With that being said, these loans work best for smaller ownership groups. So if it's one person that owns 100% of a borrowing entity, great. If it's a group of, say, 3 or 4 partners that each own, say, 25 or 33%, great. Where these deals become a problem from an eligibility standpoint is when you have like a GP-LP structure where the GP partner owns 5 or 10% of the equity, controls the deal, and you've got LPs in there for 90, 95%. That creates challenges as far as eligibility just because effectively the controlling parties own such a minute part of the deal. And in some cases, you have limited partners who have no intentions of guaranteeing debt. So work best for, again, smaller ownership deals and obviously smaller loan amounts. As far as how you can use these funds, so they can be used for acquisitions, refinances, PIPs in conjunction with refis or acquisitions. We do partner buyouts with those. You can blend in, again, working capital on these loans. And they can be used for new construction, though I would say that that's probably not happening here today. As far as the USDA program, so effectively what this program is, for anybody who's not really familiar with it, is it's effectively another federally guaranteed program where a bank makes a loan, they get a partial guarantee from the USDA. The whole purpose of the program is really to kind of cater to smaller rural markets. Really markets that sometimes lenders don't want to be in, where if a lender says, hey, I want to be in a top 100 market, or I want to be in a metro area or kind of a secondary market. The purpose of this program is to show that, smaller rural areas really are not getting left behind. So the USDA has actually a map that you can determine if your property is eligible or not. It's really black or white. You can just Google USDA eligibility map. You can type in your property address. It'll tell you if it's eligible or not. If it is eligible, the terms on these loans, loan amounts typically can go up to $25 million. However, I would say that the majority of lenders in this space typically are making loans up to around 10. As you get over 10, there's additional approval layers you have to go through with the federal government that can be burdensome. And the guaranteed portion of the loan also decreases. So, my experience with lenders is these work well up to about $10 million. Some of the other terms, rates very similar to 7A, prime-based floating rate loans. I'd say all in upper 4s, low 5s today. Terms on these loans can be anywhere from 20 to 30 years. They're fully amortizing loans, so there's no balloons. I would say that the majority of hotels typically receive 25 or 30-year terms unless it's an older asset that's got a shorter useful economic life. Prepayment penalties on these loans, again, some sort of step-down combination where the prepay burns off in the first, say, 3, 4, or 5 years. And then on the leverage side, again, this is another one of these highlights of these government-guaranteed loans, 80% leverage. These work great for acquisition deals where a group wants to buy something and project cost is going to be $10 million between the price, the PIP, and the costs and the franchise fees, and they want to borrow $8 million. So works well again with leverage. On the guarantor side, so similar to 7A, any person that owns 20% or more of the borrowing entity is required to guarantee the debt. One of the advantages with USDA, though, is there's no $5 million cap or eligibility max is what you have with SBA. So if you have somebody who owns, say, 3 or 4 hotels that are in smaller markets, effectively they can go out and borrow multiple USDA B&I loans without it having no impact on that $5 million SBA eligibility. And then where these deals can be used, again, acquisitions, refis, PIPs can be part of those. They can be used for some new construction, though I would say, again, that's going to be pretty slim right now. And then really on the 504 side, I'll just touch on this briefly. I'm not seeing these coming back quite so fast. I've had a couple projects out that we pitched as 504 first liens to banks, and it's been a pretty cool reception here so far. I think one of the main issues with 504 right now is just the whole fundamental idea of a bank that makes a first mortgage that's equivalent to 50% of the cost or the leverage of the project. That is a loan that's part of their CRE portfolio, so it's effectively increasing their exposure with hotels. And as I had alluded to earlier, I think just in today's world right now, banks are looking for a way to kind of trim their exposure or kind of figure out how to preserve and protect the loans they've got on their portfolio more so than add new loans. So again, not seeing as much 504 activity. I would say, though, that as the market does start to recover, I would expect community banks, local banks, regional banks, who are usually the lenders that have played in this space, to start to come back and probably look more into doing these 504 structures more so than just making sort of conventional or traditional real estate loans to hotels. The 504 project in itself, it's great for larger deals. So where 7A sort of falls off in that, say, $5-7 million range, 504 is great if you have a $15 or $16-17 million project, because that $5 million max US or SBA eligibility limit is only really factored in against that second lien. So effectively, if you had a $15 million project, bank lends you $7.5 million, or first that's 50% of cost or leverage. That second, it's typically up to about 30% of the additional capital stack, is going to be under $5 million in that case. So you can do larger deals, and the rates on those loans are super low right now. Those SBA second mortgages are under 3% right now. Those are 20 or 25-year fully fixed rates. The rates on the loans from banks who make the first, really that's going to vary by bank to bank. It's really a negotiation between, bank and borrower. The terms on those, again, from bank to bank, typically 10 years plus, on some sort of 20 or 25-year amortization. And the guarantor side, again, similar to USDA, similar to 7A, anybody that owns 20% or more of the borrowing entity is required to provide a full guarantee. So again, works well when you have smaller ownership groups. As the ownership groups gets more diverse and larger, it becomes a little bit more of an issue with SBA eligibility. Just transitioning quickly, I'll just touch on construction financing here for 1 minute. I get a lot of requests for construction financing. I would say over the last 5 or 6 years on any given year, probably did a half a dozen construction loans. Anybody who has obtained construction financing over the last number of years would probably agree that it's not easy. It has not been easy to obtain construction financing. I think that with the current environment, it's probably going to be magnified, and it probably gets even more difficult. I just think that overall, it's probably difficult to convince lenders right now, with occupancy levels where they are, why new rooms need to be added to a market. So I would think that lenders who historically have been in that space or been comfortable doing that are either backing away, have backed away, or if they're going to continue to do it, are going to be ultra conservative in what they do, requiring massive equity injections. Then in a lot of cases, these deals won't pencil out just based on the amount of equity that's got to come in. So, I would say that construction financing in general is probably going to be difficult here, at least over the next year or so, until we start to see a recovery in the market. As far as just maybe providing a real quick example of a current deal, and this is going to be a 7A loan, because again, this is where most of my focus is right now. It's really what I'm seeing that's still getting done. This is an acquisition deal that we're working on, Southeast U.S. Buyer and seller were originally discussing purchase price back in February, so pre-COVID. Deal got tabled or sidelined just once we hit March, and effectively both parties resurfaced in May, or just about a month or so ago. Buyer is able to get a pretty substantial discount on the price. The reason why the deal works is a couple reasons. Number one is the property itself has recovered dramatically from a low point in April. So you see a large uptick in occupancy in May compared to April. You see a tremendous uptick month to date in June. And so the occupancy numbers, or the RevPAR, really is down, but it's not down that much over where it was during the same period of 19. So, sort of a snapback on that property has been pretty dramatic. Other than that, buyer's got a lot of liquidity, so he puts in his equity to acquire, and he's got plenty of liquidity over and above that. So, if there are any challenges going forward, if there's any sort of turbulence or, the market stays rough for a period, the guarantor can kind of weather that storm. That's an 80% leverage deal. It's a 5% rate, 25-year amortization. So, a fair deal is what I would consider in today's market, just based on the scarcity and the lack of capital. So I think that really that's it on my side. I think the last thing I would just leave everybody with is, I know it's clearly been a difficult last 90 days for anybody in the industry. I guess hopefully everybody is in a position to pull through over the next 6 to 12 months and hopefully finds himself on better ground here sooner than later. So that's all I've got on my end, Robert.
Thanks, Tim. It's great information, and we'll leave your contact information and also Tanya's team up. And so anybody who wants to reach out to them, Tamara, who works with Tanya, has been very helpful to us pre-COVID and just advice related to CMBS. And obviously, Tim's been a resource too. So anybody has any questions for me, my information is there. We're going to continue to do these until we see the amount of interest start to wane. So if you have any suggestions for future guests or topics, please reach out to me and we'll do our best to incorporate it. And thank you all for your time.